Hi everyone, Amanda here from Buyers Agency Australia. Before we dive into today's topic, please note this is not financial advice. Everything I'm sharing here is general in nature, designed to educate and guide your thinking, but it doesn't take into account your personal financial situation. Make sure you seek professional advice before making any investment decisions. Now, let's get into it. In this episode, I want to walk you through the top 5 questions we get from clients all the time. Whether it's a first conversation, a strategy call, or even after they've bought a property, these 5 questions come up again and again. Question 1. What if I buy in the wrong area, or worse, buy a lemon? This is probably the most common anxiety we hear, and I get it. Buying property is a big deal. Nobody wants to make a 6-figure mistake. But here's the thing. If you follow basic investment principles and do your due diligence, this fear becomes mostly irrelevant. Let's start with the first part, buying in the wrong area. This usually happens when people buy based on poor advice. They chase cheap regional properties that look good on paper, aka cash flow, but have no real growth drivers. If you stick to the fundamentals, metro locations or well-connected metro-adjacent suburbs, low vacancy rates, strong infrastructure, and employment diversity, so not mining towns, then time will usually forgive most mistakes. Even if you slightly overpay or the property isn't perfect, if it's in a good location, over the years, the market will usually carry you forward. But what if you buy a lemon? This could be a property with hidden maintenance issues, structural damage, bad design, or defects that make it hard to rent or sell. That's where due diligence comes in. You need to do a full building and pest inspection. You need to look at council zoning, future plans for the area, flood risks, overlays, easements, the whole shebang. Even then, if you do end up with a property that doesn't perform well or causes issues, but you still bought in a strong metro area, you still have an exit strategy. You can sell. You might not make a killing, but you should get your money back. The market will give you liquidity and you move on. The only people truly trapped are the ones who bought in isolated towns, mining regions, or fringe estates with no long-term demand. So yes, it's a valid fear, but it's one that gets solved with logic, structure, and restraint. Question 2. I want to invest, but I have no deposit, even though I earn really good money. What should I do? This one is frustrating for people because it feels unfair. You're doing everything right. You're earning well, you're working hard, maybe even living frugally, but you still can't get into the market because you haven't been able to save a deposit. First, let's acknowledge that serviceability and savings are two very different things. Just because a bank will lend you the money doesn't mean you have the deposit to unlock that mortgage, but that doesn't mean it's over. There are 3 key strategies here, and I will walk you through each one. First one, guarantor loans. This is where a parent or family member uses the equity in their property as security for part of your loan. This allows you to borrow up to 100% of the purchase price without needing to save a full deposit. You still need to show you can service the loan, and there are some risks involved for the guarantor, but it can be a life-changing tool if done right. We work with a lot of clients in their 20s and early 30s who use guarantor loan structures to get into their first investment property years earlier than they otherwise could. Second, equity in other assets. If you already own something, even shares, or if you've bought a home that you live in, you may be able to extract equity to fund your next move. This is especially true if your income is strong and the LVR still works within bank policy. The key here is to be strategic with how and when you refinance, and that's where a good broker comes in. Third, low deposit lending. Some lenders, especially for first home buyers, allow 5% deposit loans or even less under certain conditions. Yes, you'll pay lender's mortgage insurance, LMI, but that's not necessarily a bad thing. Think of LMI as the cost of entry. If paying $15,000 in LMI allows you to get into a market that grows by $50,000 in a year, that's a smart trade. In short, don't rule yourself out just because your savings account isn't where you want it to be. Talk to a broker, explore options. You might be closer than you think. Check out our podcast where we have brokers in as guests. They are amazing problem solvers. Question 3. Where's the next hotspot? This question makes me nervous, not because it's bad, but because it signals a risky mindset. When someone asks, where's the next hotspot, what they're really asking is, how do I get rich fast? And that's not what real property investing is about. Let's break this down. There are 2 kinds of hotspots we typically see in the market, and neither of them is good. The first one, self-prophesizing investor traps. This is where buyers agents or property marketers push everyone into the same suburb, often because they've secured stock there or there is little local competition. Translate, low demand. And it artificially drives prices up. For a few months, it looks like magic. Everyone thinks they're winning. But without local demand, prices drop off and the market corrects or stagnates. The early bird makes a bit of money, everyone else gets stuck holding the bag. Infrastructure-driven hype zones. The other type of hotspot where people think they've outsmarted the system because fundamentals. These are the suburbs where a big rail project or university or highway expansion gets announced. Maybe a new hospital or metro is going in. People rush in thinking this is going to explode. And prices do jump. But then here's what happens. The growth gets priced in too early and overshoots. The hype inflates values well before the infrastructure is even delivered. Then the market flatlines for years while that overshoot gets corrected and the oversupply gets soaked up. Both of these hotspot types are dopamine traps. They feel exciting, but they're speculative and often don't align with the slow, consistent, often boring wealth building that smart property investment is built on. The better question to ask is, which markets have stable, sustainable fundamentals that will perform consistently over time? Question 4. What can a buyer's agent do for me that I can't do for myself? This question I respect. It's an honest, valid question, and the answer is equally honest. You absolutely can do everything we do. There is no secret sauce. You can research markets. You can learn the process. You can speak to agents, inspect homes, crunch numbers, and build a portfolio yourself. The question is not, can you? The question is, should you? Here's the reality. Buying one property every few years means you're not in the market every day. You don't have the momentum or visibility to keep your information fresh. The networks you build, the agents you meet, the tradies you trust, the brokers you like, they'll fade between purchases, and you'll be starting from scratch again every time. You won't have access to the same deal flow. We get off-market deals, pre-market opportunities, and agent first calls because we transact regularly. They know we bring qualified buyers and fast decisions. There's a time cost. Most people underestimate how long it takes to buy well. Countless hours on research, inspection schedules, phone calls, spreadsheets, contract reviews. It all adds up. And if this isn't your full-time job, is it really the best use of your time? We're not magic. We're efficient because we do this every day at scale. So yes, you can do it yourself. But if you value your time, your risk tolerance, or want access to better deals and tighter systems, outsourcing it to a buyer's agent like us might just be the smarter play. Question 5. Isn't the stock market better than property? I don't have to deal with tenants and the growth is just as good. I love this question because it gives me a chance to break down a few huge misunderstandings. Let's compare apples with apples. First, leverage. With property, you can borrow 80 to 90% of the asset's value. That means a $60,000 deposit allows you to control a $600,000 asset. If the market grows by 10%, that's $60,000 in equity, a full 100% return on your cash. With shares, unless you're trading on margin, which carries huge risk, you're limited to the cash you put in. You earn 10% on your $60,000. You make $6,000. It's linear. With property, it's exponential. Control. If you own shares in, say, Apple, you don't control how they run the company. With property, you control rent increases, property upgrades, value add renovations, the tenants, the managers. You influence performance. It is a tangible asset. People forget this, but the fact that you can touch, see, and use your property matters. There's intrinsic value and utility, and that helps protect it during downturns. Shares can drop to zero. Property rarely does unless something extreme happens. Cash flow. Even if the property doesn't skyrocket in value, it can give you consistent rental income, and unlike dividends, it's typically monthly and stable. With the right management, it's a passive, reliable income stream. Tax benefits. The Australian property system is uniquely generous. You've got negative gearing, capital gains tax, discounts, depreciation benefits, all of which can improve your cash flow and long-term returns. Shares, they have franking credits, but it's not quite in the same league. Look, I'm not anti-shares. I do own them, and the gambler part of my brain loves them. They're great for liquidity and diversification. But remember, you also have exposure to shares already in your super. For long-term, leveraged, tax-efficient wealth creation, property is unmatched. Now, if any of those 5 questions resonated with you, or if you've been wondering whether you're ready, whether it's the right time, whether you've missed your shot, the best way to find out is to talk to someone who's already walked that path. You can book a free 15-minute call with our strategy team using the link below. It's no obligation, no pressure, just a quick chat to help you get clear on where you are and what's possible. And while you're there, take a look at the rest of our content. All of it is designed to help you make confident, informed investment decisions. I'm Amanda from Buyers Agency Australia. Thanks for listening. And remember, the best question is the one you're brave enough to ask.